This course will show you what it takes to be a profitable and consistent Forex trader. It will show you how to get started, everything from choosing a proper broker to setting up your Metatrader 4 platform for success. You'll learn things like risk management and how to master your emotions, both of which are key aspects to any profitable Forex trader's career. You'll also learn how to come up with a game plan and have a strategy that actually gives you a defined edge when you trade. The Forex market can be a very costly venture if you don't have a proper approach. Instead of being gamblers, we want to be the casino. And with a proper education and a proper approach to the market, you can, instead of being the gambler, be the casino yourself and actually have a consistent and profitable Forex career. Before we proceed with the course, please take a moment to review our disclaimer. Trading involves substantial risk of loss and is not suitable for all investors. Any knowledge that is passed through this course is not necessarily trading advice.
Hi friends, Assalamu alaikum. This is Shofan Alamin. Welcome to my YouTube channel, How to Make Money Online, powered by bestmt4ea.com. In this channel, we discuss about making money online and try to figure out how we can be a millionaire in next 4 years. So if you are one of us and want to become a millionaire, please subscribe my channel and press the bell icon so that you can be notified about forex trading tips and other online income sources which will help you to make money online.
Alright, so let's go ahead and start with an overview of the Forex market. So what is the Forex market? The FX market, or the foreign exchange market, is the world's largest traded investment or trading market in the entire world. Every day, there are trillions of dollars that get traded hands on the FX markets. So who trades all this volume? Well, mostly it's the banks. For the most part, the Forex market is traded so heavily by banks who are converting currencies back and forth. Just like when you go into the airport and you see that little kiosk where they are exchanging one currency for another, banks are trading the FX market, converting and trading and placing investments throughout the FX markets. But that's not all of who is involved in the FX market. There's also people, presumably like you and I, that are retail investors or retail traders looking to get in on the action. So why do so many traders around the world prefer Forex? Well, like I mentioned, the Forex market is extremely high volume traded every day. There's also the ability to leverage your positions a lot in Forex. What does leverage mean? Essentially, it means, to keep it simple, if you have a small amount of money, you can leverage it up with a broker and trade it as if it were more money. Essentially, your broker is going to lend you money to trade with, and you can trade like you have more money. So with a small amount of money, you can actually trade it like a lot bigger account. So that's essentially why. The FX market is just a massive auction house, essentially. So let's talk about the auctioneer involved. Let's start with the basics of Forex trading. What is a pip? A pip is often referred to in Forex trading, and it is a small measurement of change in a currency pair, usually 1/100%. When is the Forex market open? One of the appealing things about the Forex market is that it is available to be traded 24 hours a day, 5 days out of the week. Depending on where you are in the world, this can include Saturdays and it can also include Sundays, but for the most part, Monday through Friday is when the Forex market is traded. When or what is a currency pair? A currency pair is two currencies quoted against one another. So for example, let's take a look at the US dollar crossed against the Japanese yen. What this means is that we are quoting the US dollar against the Japanese yen, and we will have a corresponding chart representing the two currencies quoted against each other. What are the major currency pairs? It is important to know which currency pairs are the major ones, because major currency pairs are ones that are traded the most heavily and will provide the most liquidity for traders to enter and exit trades. Liquidity means that you can easily get in and out of a trade because there are so many other people in the world trading, taking the other side of your trade. The majors are the pound against the dollar against the yen, and the euro versus the dollar. What you'll notice is that the US dollar is involved in all three of the major currency pairs, and that is because the US dollar is a very profound and strong currency pair across the world. Alright, so let's talk about the auctioneer that I just spoke about. The auctioneer in Forex is the broker. So what is a broker? Well, just like in real life, if you were to try and sell your house, you would have, presumably, unless you sold it yourself, a broker that's going to help you sell that house. Now, if you sell that house, the broker takes a small percentage of what is made on the house sale. In the same way, the Forex market has brokers, which are kind of like a middleman to enter and exit positions on the FX market. So if you want to buy the euro, then your broker is going to offer you the platform and offer you access to take that position. Now, how are they going to make their money in this? What's in it for them? They're going to make money every time you take a trade based on two main things: spreads and commissions. First, we'll talk about spreads. Spreads are going to be the idea that, okay, if you want to buy the euro, then the FX broker that you use may add something like, let's say, 2 pips to the current price. It's trading at one price, but the broker's actually going to offer it to you at 2 pips higher than that, and they are going to make that 2 pip spread on your trade. So that's spread. The other one is commissions. Now, with every FX broker, it's a little bit different. Some offer commissions, some offer no commissions, some are cheap, some are expensive, but for the most part, Forex is pretty competitive in their brokerages for commissions and spreads, which is very nice as a retail trader. So commissions are going to be your cost per trade. So let's say that if you want to take a position on the euro, you're going to get charged some percentage of your position size, something like that. In the stock market, it's often around like $5 per trade in the American stock market. But in the currencies market, it's often a lot cheaper, which is very nice. So what is the difference between a regulated and unregulated broker? So one thing that's important to note is that in each country, there are going to be companies that are used to approve or disapprove brokers. So in the States, of course, there is the FDIC, which is going to essentially make a judgment call about certain financial companies and essentially pass or fail them. Now, if a company or a broker is regulated, it's for the most part a positive sign that they are probably, for the most part, pretty trustworthy. Now, if they are unregulated, it does not necessarily mean that they are a bad broker, but it is cause for concern for more research to be done. You need to be very careful if you're going to use an unregulated broker. My personal recommendation is definitely to use a regulated broker in your country that is going to be a lot safer for you. Okay, so now that we've talked about what a broker is and what the best way to look for a proper broker is, we're going to talk about the Metatrader 4 trading platform. Many brokers, if not almost all brokers that I know of, offer Metatrader 4 as the trading platform. The picture you can see on the right is a picture taken off of a Metatrader platform downloaded on my computer. So Metatrader is going to be your terminal for placing and opening and closing trades on the currency market. As you can see Oanda in the navigator panel on the left there. Now, Oanda is my broker, like I mentioned previously, and you're going to see that this entire terminal was offered to me by Oanda. So to get access, what you're going to want to do is, for most brokers, it should be very clear and easy to follow on how to get Metatrader on their website. So for me, Oanda, I go to the website, and it's very clear that once I log in, you can see an easy download Metatrader 4 platform, and then you'll have their version of Metatrader available to you to trade. So now we're going to go into the chart, and I'm actually going to show you the platform and give you a dynamic walkthrough of just the overview of Metatrader. So we've mentioned our example of buying the euro earlier in this course, but what does it actually mean to buy a currency pair? We mentioned the euro, but this is the euro-US dollar. So what does that mean? If you have only the access to pairs of currencies rather than just buying the euro, what does that mean? Well, actually, buying the euro-USD is not as simple as simply saying the euro is going up. Buying the euro against the US dollar is speculating that the euro will go up and the US dollar will go down. So if you take a buy position on this, you think that the market is going to go up in this currency pair. Essentially what this is saying, euro-USD, you need X number of US dollars to get 1 euro. If you think about it that way, it's not too complicated. So if the price goes up, it means that you need more US dollars to get 1 euro. So hopefully that makes sense. But moving on, we're going to talk about the difference between buying and selling, or long and short. They are pretty much the same thing, but what you're going to be saying here is, if you're buying, you speculate that the price will be going up. And if you're selling, obviously you think the price is going to go down. Same applies with long and short. It is the same concept. Long meaning you think it's going to go up, and short meaning you think it's going to go down. But when you're shorting or buying a currency pair, you are actually always speculating that one will go up and one will go down. So let's say we want to actually short the euro-USD. What you're saying in this case is that you think the euro will go down and the dollar will go up relative to each other. So it really is kind of a proportion to each other. So the euro-USD, or let's say the Australian dollar versus the Canadian dollar, those are currency pairs. That's speculating that one will go up and one will go down. Like I said, buying this pair is going to assume that the euro goes up and the dollar goes down. That is what you are speculating. So, like I mentioned as well, if price does move up, it means that the euro has appreciated against the dollar. Now there's multiple different pairs for each currency. So let's say we, instead of the euro-USD, we looked at the euro-Swiss franc. The ticker symbol is EURCHF, the euro-Swiss franc. So in this case, if the price moved up on this chart, it means that the euro is appreciating relative to the Swiss franc. Placing a trade order. When trading the Forex market, there are a couple different ways that we can enter and exit a position. Some of the examples that we're going to show you now are a market order, a limit order, and a stop order. These are different methods that have certain applications for entering and exiting positions. When we are ready to actually execute an order, we can open up our Metatrader 4 platform and go up here to this button, New Order. What you'll see here is that we have our symbol, in this case looking at the US dollar versus the Swiss franc, and we have our volume, which is going to be our lot size. We are going to have the opportunity to set a stop loss and a take profit, as well as choose if we would like to place a market or a pending order. Then we can sell or buy by market, and our position will be filled, and you'll be able to see it, like we mentioned earlier, in the trade section of the terminal. Our first example of an order type for placing trades is a market order. Now, a market order is going to enter a position at the closest available price upon execution. So this is the fastest way to enter the market. For example, if we see a price that we like trading currently and we decide we would like to take a position, a market buy is going to enter us at the closest available price and put us in a long position. Our second order type is a limit order. Now, the best way to explain a limit order is actually through an example. A buy limit order is a pending order below the current price, and a sell limit order is a pending order above the current price. This implies that price is currently not trading at where we would like to enter. However, if price does go to that level, we are interested in taking a position. Notably, the price for a buy limit order is going to be below the current trading price, where we would like to enter the position. So in the illustration below, you can see that if price goes to your limit order, it will then get you filled. If price does not go there, you will not get filled. You might use a limit order if you think that at a certain point a currency is oversold or overbought. In the illustration below, you can see if price came down to our level, we were ready to purchase the currency pair in an effort to watch price then appreciate and go up, earning us a profit. Order type number 3, a stop order. A buy stop order is a pending order above the current price. And likewise, a sell stop order is a pending order below the current price. Now, if you remember, a limit order is actually the opposite of this. For a buy limit, it is a pending order below the current price, but for a buy stop, we are looking for a pending order above the current price. Now, this is important because if you try to place a buy stop order below the current price, you'll have some sort of error and won't be able to do it. So it's important to know which order to use in the right period of time that you're trying to trade, or the right price level that you're trying to trade. So in the illustration below, you can see that price first goes down, and let's say that if price breaks through a certain point, we think it's going to continue in the direction. So as price goes down, we say at a certain level, we think there is a critical point where if it falls through, it's going to break down and continue further. This would be a great point to use a sell stop order. Take profits and stop losses. What is a take profit? A take profit is going to essentially be your target for the trade once you are in it. So for example, if you take a buy position on the USD Canadian dollar pair and you place a target or a take profit 50 pips above the current price, from there, if the price gets to your take profit, you will automatically be closed out of your position for a profit. Now, on the other hand, what is a stop loss? Similarly, we can set a point on the chart where you determine that you were wrong or the trade didn't work out. This is the point that you're going to stop the loss, as the name implies, and close the position at a loss. Let's say in this case, if you are long on the US dollar versus the Canadian dollar currency pair, and you place your stop loss 25 pips below, if the price goes below your entry by 25 pips, you're going to automatically be closed out at a loss. In this lesson, you are going to learn how to modify an existing order. Also, you'll learn how to cancel an order that's already been placed as a pending order, as well as closing a position that is already open. Okay, so we're back on our Metatrader 4 platform, and I'm going to show you how to modify an existing order. So this is an order that's already filled, and we are long on the Euro-US dollar. So if we want to modify this, let's say we want to add a stop loss to our trade. What you can do is you can simply drag from the order itself on the chart and pull down, and what you'll see on the left hand side here is that we have a stop loss in place now. The SL means stop loss, and what you'll see here, the TP is the take profit. So now our trade has a take profit and a stop loss set. So next, what we're going to look at is how to cancel a pending order. Well, first, let's generate a pending order. For example, we'll go to New Order, Pending Order, and let's say we want to set a buy limit. And we're going to put it some point lower than the current price. There, we have a buy limit a certain distance down from the current price level. So if we want to modify this one, we can double click and you'll see we can change the stop loss or take profit here. Let's say we just add some random take profit and stop loss just for demonstration. You can also change the price at which the pending order is sitting. This is, remember, a buy limit order because it is below the current price. And we can click modify. And there we go. Now you'll see it has a stop loss and take profit of its own. Now, if we want to cancel this pending order, we can simply come down to our terminal in the trade section and go all the way to the right and click the X box. You'll see it's off our chart and no longer going to enter us in a position if the price goes down to that point. And finally, if we want to close a position, we can either close it here with the X box as well, or we can double click the order itself and click close. And there you have it. In this lesson, we're going to talk about drawdown. What is a drawdown? A drawdown is essentially a position that has gone against you, but is not yet closed. For example, let's say that you are long on the US dollar versus the Canadian dollar pair. If the price goes against you, in this case it goes below your entry price because you're long, this is what is called a drawdown. Now, if the price has not yet gone to your stop loss, if you have one in place, until you close the position or your stop loss is hit, it is not actually a loss on your account. In fact, the only way to affirm or solidify a loss is if your position is closed. Until it is closed, you are only in what is called drawdown. Now we're going to show you how to create a new demo account in Metatrader 4. So what you want to do first is make sure that you've logged in or downloaded your Metatrader 4 platform from your broker, like mentioned earlier in this course. Assuming you've done that, we'll go over here and right-click Accounts. Then you're going to want to click Open an Account. If you already have a demo account, at this point you can click Log in to a trade account and log in to your demo account. But in this case, to create a new demo account, we're going to open an account and we're going to find whatever your broker's version of a practice server is. So for Oanda, the trading server that we're going to use is Oanda Practice. Click Next, make sure it says New Demo Account. We're going to agree to subscribe to the newsletters and enter just some information. Click Next, and there you have it. You'll hear some noises, and there you have it. You now have a practice
incoming mail.
You'll have your account history, trade section, and from here you can place and execute trades, and you'll be able to keep track and practice with your account. When approaching the Forex market, every trader needs to have a game plan. Without a strategy, you are essentially gambling, and gambling over the long term will result in failure. Now, a lot of beginner traders will think that taking a position has a 50% chance of going in their favor and a 50% chance of going against them. But this is not actually the case. The reason it is not the case is because you have to factor in things like commissions and spreads, which are your trading costs. This makes it more against you as a trader to actually be profitable. To any good trader, risk management is absolutely key. You have to control your risk in order to optimize your profits. Many beginners think that it's all about the reward or making tons of profits and doubling your account. The problem with this is this ignores completely the idea of risk management. In order to practically make money in the Forex market, you need to always have risk in mind. You need to know what you're risking at all times in order to potentially stay in the game longer. Now, one of the most important things when approaching the market is to pay close attention to your psychological discipline. Earlier in the course, we showed you how to get started on a demo account. There is one problem, however, with using a demo account. This ignores possibly the most important part of trading, and that is psychological discipline. Because you're using fake money on a demo account, you don't learn the rules and the feeling that comes with trading with real money. When you lose money, it is very taxing on your mind, and when you're up, you get very euphoric. The problem with this is this emotion can actually lead traders down the wrong path. Knowing how to learn and control your psychology as you trade is vital, and this itself could have an entire course on how to properly manage your own psychology. But simple rules of thumb come with the saying, plan your trade and trade your plan. As long as you understand that you must stick to your strategy and not change anything based on your emotions, you are setting yourself up for success in trading. With a proper strategy and proper psychological discipline, as well as key focus on risk management, you can have a successful trading career in the Forex market. Now, a recommended approach is to start very small when first getting into the Forex market. What do I mean by this? I mean, don't play with a lot of money to begin with. Understand that it's very likely that when you first get into trading, you will not be profitable. In fact, you should pay more attention on making small gains repeatedly and employing proper risk management, proper psychological discipline, and sticking to a trading plan. Coming up next, we are going to set you up with the proper strategic mindset to create your own trading strategy. From there, you'll learn a couple different tools that traders can use to create a strategy, as well as how to test your strategy against past data. So let's see you in the next video. The power of indicators. Indicators are tools that you can apply to your chart that will help inform you about potential trade opportunities. They can be used in your strategy guidelines. Like mentioned previously, we need a game plan. So an indicator can be a great way to potentially show you an area on the chart that you might be interested in taking a trade. The RSI, Bollinger Bands, and Fibonacci retracements are a few examples of some indicators that we can use. Essentially, an indicator is going to show us points on the chart that have substantial meaning or readings. For example, the RSI is a relative strength index. It's going to indicate levels of overbought or oversold levels where price has stretched far one way or the other, and we could potentially take a trade in the opposite direction. Now we're going to get on the charts and show you a few of these indicators in action. Alright, so we're back on our chart here in our Metatrader 4 platform. We've got the Australian dollar, Canadian dollar currency pair pulled up on the screen. We're looking at the 1 day or the daily bar chart. So what we're going to do here is we're going to add an indicator to the chart. We're going to add the RSI indicator to the chart. So first what you want to do is you can come up to here. You can either do it in the navigator, you can go to indicators, but you can also do it another way. Let's say we hide the navigator, and we're going to click Insert, Indicators, and we're going to scroll down to Oscillators, Relative Strength Index. Click it, and it's going to bring up some settings. We're going to keep them at the default for now. What you'll see is it populates on the screen down here, the Relative Strength Index. So you might not know what this is initially, but I'm going to explain it. So what the Relative Strength Index is going to do, the RSI is going to show you levels of extreme movement. Now essentially, I won't get into the math behind what creates the RSI or what calculates the RSI. You can do that online. It's super quick to find it. Now what you're going to see is that this is going to print extreme levels in the market. So what you'll see is that we've got two dotted lines here. Now if we double click on the relative strength index, pull back up the settings, you can see that we've got the parameters here. Now we've also got the levels, and you can see that there's a level 30 and a level 70. Now what that's going to show right here on the right, you'll see the 70 and the 30. These are our extremity level points. So by default it's going to be 70 and 30. You can see right here that we've crossed below the 30 level, and that's showing that the price as it is at a severe oversold level. Now if it were to cross above here, we would say that price is severely overbought. So we can grab our crosshair here, and you'll see we got a pretty good signal here that price was extremely oversold. So when we got to this level on the chart, you'll see that we had a nice reversal from that point. Now it's not always going to be so easy, it's not going to be so perfect, but this is a great indicator for showing points on the chart that price has crossed into an extreme level. Now we can also toggle this. If we go back into our settings, go to parameters, we're currently looking at the 14 period, which means we're looking back 14 bars to make our calculation. Now if let's change it to 7, for example, cut that in half, and let's click OK. What you'll see is we get a lot more signals of overbought and oversold. Right here, you can see we got an indication of an overbought level. So we could have placed a trade in the opposite direction, or a short position. So you'll see that it presented a nice opportunity to sell off and make a profit on the way down. Now, on the other hand, like I said earlier, we got a signal here in this general area to potentially look for a go long standpoint. Why is that? Because we crossed extreme levels on the oversold level. So that's the RSI. It's a pretty useful tool. I use it in my own trading. Extremely useful for finding points on the chart where price has reached an extreme stretch. Another one that we're going to show you, another indicator, let's get rid of this by right-clicking and clicking delete, is the Bollinger Bands. Similarly, we're going to find extreme levels with this indicator as well. You can go to Bollinger Bands here, under Trend, Bollinger Bands, and we're going to again use the default settings. Now what you'll see is it creates these 3 lines. Now what this is going to show is the Bollinger Bands. If we go back to the settings really quick, parameters, we're looking 20 bars back to create a channel. Now deviations, what this indicator is going to do is it's going to look back in the last 20 bars, and it's going to find the point where price is mostly trading in. What you'll see is then we have 2 standard deviations from the mean of how much the price has moved. So this is our mean. This is a 20 period moving average because we're using the 20 period. And if we close this, you'll see that price for the most part stays inside of these 2 Bollinger Bands, the upper and lower Bollinger Band. Now when it does indeed stretch outside of the Bollinger Band, it is a potential signal that price has stretched outside of its comfort zone and is ready to reverse. In this case, as you can see, very nicely reversed back down all the way to the lower Bollinger Band. You can see we clicked and dragged with the crosshair, and it was a total of 2,876 points, or 287 pips approximately. So with that said, this is the Bollinger Bands. They don't always work perfectly, but they are a great way to look for overstretched price, just like the RSI. Now, the next one we're going to look at, let's delete the Bollinger Bands. We're going to look at, and I have not even looked at the chart to find this, I just think it's going to work out nicely. This is cool. So what you'll see is I can go right here. I don't even have to open an indicator for this one. I can go to this Draw Fibonacci Retracement. Click that, and you'll see my cursor is lit up with something. And what we can do, let's see if we can find a opportunity to do this. So what we're going to do is we're going to go from the high point of this move here all the way down to this low point. And what you'll see, let's make this a little bit easier to see. Right click Fibonacci properties, and we're going to change the levels to, let's make them black. Okay, so what you'll see is that we had this move to the downside. Then we retraced back up. Now what you'll see nicely is that these Fibonacci retracement lines are going to look at points where the market is likely to pull back to before continuing in the direction of the original move. So we had this nice stretch to the downside. I'll demonstrate with a trend line. Now we can clean this trend line up. Right click the trend line. Let's change it from array not to array. Change it to black, and we'll make it a little bit thicker. So we had this move to the downside followed by a retracement off of the lows. Now if you see, we moved right to the 50% retracement level. You can see it over here, the 50% retracement level. A lot of times, price after a move will retrace or correct back a certain portion of the original move before continuing to the downside. So this was a very nice continuation Fibonacci retracement example. So now we can just delete all of this. So that was the Fibonacci retracement tool. Fibonacci is a very interesting thing. It is essentially a idea that is commonplace in nature. I highly recommend you to look it up online. It's very interesting. But the Fibonacci lines are essentially trying to look for levels of potential reversals. And so that is kind of a cool tool. Maybe in a later course we'll go more into detail about Fibonacci. But as you can see, it's very interesting how these levels tend to repeat themselves, and there is possibly a profit potential there. Okay, so with that said, that is essentially your introduction to indicators and applying them on your chart. There's more here you can play around with, and you can do some research online to find out about what more of these are. You've got the MACD, momentum indicators, all sorts of different tools that will help you take a look at the chart and be told something about what's happening. The power of price action. Price action refers to the X and Y coordinate of a chart. X on a chart refers to the time, and Y represents the price. Some traders base their entire trading strategy on price movement compared to time alone. They look for clues in the market that might signal potential reversals or continuation. This includes things like candlestick patterns, support and resistance levels, and moving averages. Now we're going to show you on the Metatrader 4 platform examples of some of these concepts. Okay, so we're back on our Metatrader platform, and what you'll see, we have a Euro-US dollar pair open on this chart. Now what I'm going to show you is an example of a candlestick pattern. So we're on the daily bar, daily chart here. So each one of these bars or candlesticks represents 1 day of trading. So what we're going to look for here is I'm going to show you an example of a pin bar candlestick pattern. So what this is going to mean, if I press F12 on my keyboard, I can go 1 bar at a time and look through history. So you can see we have this really big steep sell-off on the euro. Now what's going to happen next, you'll see a continuing selling until we see this. This candlestick is very interesting. So we had plenty of selling. The bears were in control. They were selling this market until we came to this point in particular. At this point, the market, you'll see it opened at this level and it sold off just like it had in the previous days. But then the reason you see this wick here is because towards the end of the day, the bulls rallied and pushed it back up to where it started. This is exactly what a bullish pin bar looks like. So we had a sell, and at the very end we had rejection. The bulls stepped in and bought this market back up to the point that it came from. So what you'll see is if we go forward, a very nice reversal occurred, and that would have been a great trade based on a bullish pin bar. So that's an example of a candlestick pattern. So the next one we're going to look at, the next one is the idea of support and resistance. Now, support and resistance is the idea of supply and demand, essentially. What we're saying here is that these are points on the chart where people are buying or selling a thing in the past, and we're going to look to potentially have a similar effect in the future. So if that doesn't make sense, hopefully this will. I'll just demonstrate. What you'll see here is that price was on a bullish move, and it came all the way up to this point before pulling back. Now at this level, it strongly bounced off of that point. So what we're going to do with a support and resistance line is we're going to grab a horizontal line from the toolbar, and we're going to drag that right to the point where the market reversed. So the market consolidated here for a while before bouncing up. It pulled back, and at this level again, the buyers stepped in and pushed the price up again. So now, assuming that we're at about this point, we see the market pull back again. At this point, we know that there's demand likely waiting at this level. So we could potentially place a buy trade here based on the previous level of support that held. So this is our support line. Now when we potentially go long here, you'll see it had a nice rally and pushed off of that support level and again pushed higher. So from there we can do another example. Let's another example of support and resistance. You can see when price came up to here once, it was rejected strongly by the sellers. In this case, the sellers had control and pushed the market back down. Again, it came up a second time, and if you were looking to take a sell position here, this is what we call a double top example. So we had a rejection off this level, and when it came back up, it was rejected again. So a sell trade could have been a nice position here. You'll see here it didn't work out so well. In fact, the bulls pushed it so strong that this shows that new demand has stepped into the market. And again, when it pulls back, that previous level that was rejected was actually turned into a level of support now because demand became stronger. Hopefully that makes sense. The idea is that we're looking at supply and demand. When we see price break through a significant level of resistance, in this case, and come back, we're going to potentially look to take buy trades in the direction of the push, thinking that now the bulls will defend this level and treat it as a level of support. So that's just the idea of support and resistance, is essentially drawing lines of supply and demand levels and using them to place trades in the direction that the market tends to want to go at those levels based on the past. So that is support and resistance. Now finally we're going to look at some, let's get to our dollar Swiss trade and let's put it on the daily. Next we're going to look at some moving average trading ideas. Let's take the 20 period moving average. Let's make it blue. We're going to place it onto the chart. You'll see we have a moving average. This is just going to be the moving average, or the average of the last 20 bars is what we said. And quickly, let's add a second moving average. You'll see why in just a second. So this is going to be our 50 period moving average. It's going to be a little bit slower. You'll see price moves a little bit quicker than this one. And you'll see that the blue line, which is our 20 period moving average, is much quicker than our red line, which is our 50 moving average. Now, some people like to use moving averages. There's lots of different ways to use moving averages, but one way that's very popular is the moving average crossover strategy. Now, this is a very simple strategy, and I don't recommend you just use this blindly without at least researching it more, or testing it yourself, or trying it out, or combining it with other indicators or other ways to trade this. But what you'll see here is that when we have a significant cross of the fast period moving average across the slow moving average, it's a signal that the market is potentially changing directions. And some people will try to take a direction, take a trade in the direction of the cross. So you'll see that the fast moving average moved above the slow moving average, and this was a great signal to go long. You'll see we had a massive rally here, and you would have held this trade until it crossed back over here. So that would have been a great example of a moving average price action based strategy. In this lesson, we're going to talk about momentum or trend following strategies. This is the first of two general technical strategy concepts.
the second being mean reversion or counter trend trading. This section is going to focus on the idea of trend following or momentum strategies. Now, momentum or trend following traders will generally try to go in the direction of the general market flow. This means that instead of trying to fight moves, generally trend followers will try to join the general market flow and take advantage of large moves. Some traders prefer to join an existing trend and ride it out for all it's worth. This generally means that if a chart is moving up, or has been recently with a lot of pressure, trend following traders are going to look to join that move in the hopes that the move extends itself further and they can make a profit. Next, we're going to show you an example of a breakout trade, a very rudimentary example of a momentum trader's bread and butter setup. We'll also go over the moving average crossover strategy, which is a very common trend following style setup. Now we're going to move to the charts and you'll be able to see both of these in action. In this example, we're going to talk about a breakout trader's bread and butter setup. What you'll notice here on the chart is that we have a key level of resistance. What that means is that price has come up to this level and historically fallen from it or been rejected as it comes back to the level. So each time sellers regain control and push the market back down. However, a breakout trader is going to look for opportunity when this key level breaks. So as you'll see, price is continuously being pushed off of it, but at some point, price gains a lot of momentum and pushes right through the level. So as a breakout trader, what we are going to do is we're going to patiently wait to see if this level gets broken. And if it does, we are going to join the trade in the hopes that we get a extended push away from that key level. So in this case, multiple times we rejected the level here, but on this attempt, what you'll see is that price pushed and continued to move. This is a momentum-based strategy. We're looking for continuation as a key level is broken. So for a breakout trade here, we would be looking to make an entry if price broke significantly upwards from our resistance level. So in this case, you might set up the trade like this, where you have an entry or a buy stop above the key level of resistance in the hopes that you can head up to your take profit here or a continued move after price breaks. In this case, we'll also manage our risk by placing a stop loss underneath this resistance. If price falls back into the range, we are no longer interested in the trade because the momentum is no longer there. We are purely looking for momentum to continue to the upside so that we can make a profit if price continues to break out further. Our next strategy is going to be the moving average crossover strategy. This one is relatively simple and is the trend trader's bread and butter setup. So what we are looking for here is simply a moving average cross that will signify a potential move or trend change directions. So here we have a slower moving average, which is the red moving average. We're using the 20 period, and a faster moving average, which is the 10 period moving average. You can change these to anything, but really what matters is that you have one that is slower than the other. Your slower moving average is going to be more of your trend setter, whereas the faster moving average is going to be the momentum change. So what you'll see here is that at this key point, price had pushed to the upside, and the faster moving average, the blue line here, has crossed above the red moving average. This signifies that there is a potential change in direction and the trade might go profitably if we join into the trend. So here what you'll see is that if we had joined the price or joined the trend at this level, let's say on the open of this bar, you'll see that a large trend developed and we didn't get out of the trade until, again, the price crossed somewhere around this range. So you could have gotten about 500 pips of off of one trade here. Again, what you'll see is we have another trade example here, this time on the short side. As price broke down, the faster moving average crossed below the slower moving average, signifying a potential change in directions. Again, we have a nice trade here that would have yielded a profit. This takes advantage of the market's tendency to occasionally trend, causing long movements in one direction that traders can jump on and take advantage of large movers. The second strategy type that we're going to talk about is counter trend or mean reversion trading. So basically, counter trend traders are going to be going against the general flow of the market. In the previous lesson, we learned about momentum-based strategies, which tend to go with the flow of the market. But counter trend trading is a little bit different. This time we're trying to go against the crowd. Counter trend traders are mostly looking for reversals after a move seems stretched or ready to change directions. We're looking for points on the chart that price has reached an extreme and will likely revert back to the mean or back to previously traded levels. In the past lesson, we were looking at the breakout. Oftentimes, a counter trend or mean reversion trader will find these spikes after they've moved extensively and look to trade them back down to a more recently traded level. These guys are looking to trade the market more like a rubber band, looking to find stretched points and trade them back to more appropriate levels. Now that you've learned some of the tools that traders can use to build strategies with, we are going to create a simple example strategy. What we'll do is we'll combine some of the things that we've learned, such as price and indicators, to create a technically based strategy. And then we're going to learn how to test it out or see how it holds up. All of that next as we move on to the Metatrader 4 platform again. Now we are going to build a simple sample strategy. This is going to show you the process of trial and error that a trader must go through when developing his or her own strategy. So what you'll see here is I grabbed a few indicators that I think will work well for our strategy. You'll notice we've got the RSI down here and Bollinger Bands applied to the price above. So what we're going to do here is a simple trading strategy is we are going to say that if price closes outside of the Bollinger Bands as well as extends past these levels on the RSI, we have a very stretched price and we will try to trade it back in the direction that it came from. So this is going to be a counter trend trading example. Like we showed you earlier, there are trading strategies that go with the trend, such as the moving average crossover and breakout trading, but this will be an example of a counter trend trade. So first, what we'll do is we're going to use this vertical line to look for our setup. And I'll show you an example of what our setup is. Notice here, price did close below our Bollinger Band, but we didn't quite have an extension on the RSI saying oversold. Even though it would have been a great trade, we did not take that one because it did not fit our plan. Here, though, you'll see that we had an overbought indication on the RSI. Notice we're also using the RSI 4 period rather than the default 14. This is much faster and will give us more extensive readings on the shorter term, but it can be useful for getting in and out of trades quicker. So you'll notice we had an extension that closed above the Bollinger Band's upper band, as well as an overbought indication on the RSI. This would be a case that we would take a short position. So we would take a short position here, and our target could be one of two places in this strategy. But for simplicity, I'm going to make our target the middle Bollinger Band. Some traders prefer to use the Bollinger Band, the lower Bollinger Band as an exit tool, but I'm going to use just the middle band. This is really going to be a simple scalp on the on the counter trend side. So when we have this bar close, on the very next bar, we're going to take a short position. So you can see we took a little bit of heat on the trade, but eventually rolled over and made a nice profit, and that is roughly 666 points, which is about 67 pips. So again, we did not close below here, so we did not take a trade, we did not close here, but we did close here. And what we'll see is, on the RSI, we also had an indication that it was overbought. So again, we would have taken another sell trade. So, on the very next bar, we would open a position short. And in this case, if we were going for the middle Bollinger Band, we would have had a 113 pip gain. So let's go ahead and find another one. Here we didn't close below. We did get a stab through the lower Bollinger Band, but we didn't quite close. And our strategy is only when it closes below. Here's one where we took a little bit more heat on the trade. You'll see we closed above the upper Bollinger Band, indicating that we would have taken a short position. As you'll notice, down below, we also had an overbought reading on the RSI. So in combination, that would have been a sell trade. And what we'll do here is we would have opened on the next position, and this would have gone against us a little bit. We had an 89 pip drawdown, if you remember that term from early in the course. If not, you should go back and review that. Essentially, the trade went against us and we were down 89 pips at one point. But eventually the price rolled over and mean reverted back to this middle Bollinger Band, which gave us about a 20 pip gain. So we can go on and on doing this. This is a simple strategy that does very well in a choppy market or a sideways market. So that is something to keep in mind. Sometimes certain trading strategies will work better in certain market dynamics than others. So with that in mind, let's talk about how we can test our trading strategy. We're going to go ahead and get into that in the very next clip, so stay tuned. How to test your strategy. Once you have a system, it is very important that you apply the concept of trial and error to your system and test to see how it holds up historically. What I mean by this is that once you've created an idea, for example, our past example of the Bollinger Bands and overextended RSI trading system, we need to take that idea and see how it actually does in the market over history. So this is what is called a back test. It is almost like an experiment. Once you have your strategy rules set up, you need to see how well those rules actually do. Now, a backtest does not necessarily mean that your strategy is going to succeed in the future, but it is definitely positive. The strategy performing well over a large sample of data in the past says that there is a good chance that in the future the strategy will continue to do well. This is a huge plus for trading your strategy because you'll have more confidence. For example, the algorithmic strategies that I run have backtests going back to about 1995, all the way back today, and they show positive edges in the market. You need your own system with an edge that is very clear over large sample point data. So to do this, how can we get started testing our system? Well, for one, if you do have programming experience, you can actually program your system in Metatrader. I'll have a future course going on about all about expert advisors or automated trading systems, and these can be automatically back-tested in Metatrader 4. But assuming that you don't know how to code or you are not interested in finding a person to program your robot for you, you can test your strategy manually. Before I knew how to program in Metatrader, I did this myself. So what you can do is take your strategy, just like we did on the previous video and took a look on the chart of examples. You can go back and manually, with a piece of paper and a pencil or an Excel spreadsheet, go back on the charts and test your strategy. Find where you would enter, find where you would exit, and go as many trades as you would like, or as many trades that you would feel comfortable with calling a backtest, and see how it does. So we showed you some previous example trades with our sample strategy. Now what you could do is take that same strategy or your own strategy, scroll way back on the chart, and painfully slowly go through and test how your strategy would go. I say painful because backtesting is not always fun. Sometimes it's very slow and it takes a lot of time. But this is an extremely necessary process for anybody who is serious about trading. You need to know if your strategy seems to work. Otherwise, why trade at all? You need to have a plan, and you need to have a plan that has a history of success. So with that said, one more thing that is imperative to having a well backtested strategy is that you have a lot of trades in your experiment. You can't just look at a strategy and see if it works 5 times, it must be a profitable strategy. Instead, you need to know about the best of times and the worst of times of your strategy. How much risk or leverage should you use in this strategy if you have a certain drawdown? For example, if you have a 20% drawdown at one point in your trading strategy, you should not exceed a bigger lot size or a bigger position size, because if you go with too big of a position size in this case, you run the risk of blowing up your account. So you need to know what is your strategy's weaknesses and what are its strengths. Does it trade in certain markets well? Does it trade poorly in certain markets well? If the market is highly trending, does your strategy do better or does it do worse? These are all examples of using trial and error and experimenting with your strategy to find your edge. Now, one other thing is that once you do find a strategy, a major pitfall for traders is they find a strategy that seems to be a profitable strategy and have an edge, but they ruin the edge because they let emotions get in the way of their trading. Once you have your strategy, it is imperative, like we mentioned earlier in the course, that you plan your trade and trade your plan. Experimenting and backtesting is planning your trade. Once your trade comes up on the chart, you need to trade your plan. These are some simple tips, but they actually make a world of a difference for traders. And testing your strategy and applying it as you tested it is extremely important in creating a successful trading career. Now that you've reached the end of the course, we are going to do a recap on everything that we talked about, as everything that was mentioned in the course was mentioned for a reason. First, we talked about how to find a proper broker. Now, this tip was extremely important, and a lot of times new traders will overlook this. Without a proper broker, you might get charged high commissions or spreads. It is important to find a fair broker who is easy to deposit and withdraw with, as well as will charge you fair trade costs. We also talked about how to navigate Metatrader 4. When you first open Metatrader 4 as a new trader, or even as an experienced trader, it can be a little bit confusing how to get yourself around. We talked about things like the navigator bar, as well as the market watch panel, so that you could find currency pairs that you would like to trade. We also talked about the different types of orders and trade management tools. Remember, we talked about limit orders and market orders, as well as things like our take profit and stop loss. We also mentioned or explained how to get started with a demo account. A demo account is a great way for a new trader or even an experienced trader to try things out on the live market without actually exposing themselves to any monetary risk. This will allow you to practice your trading strategies as well as learn some good habits. We talked about one of the most important or core concepts of any good trading strategy or trader in general, and that is discipline and risk management. More specifically, we mean psychological discipline. It is extremely important as a trader to keep a level head and to stick to the plan once you've had a proper strategy created. In addition, risk management is key, because if you risk too much or you don't know where you should get out, you are risking the entire account at any given time. So it is very important to keep both of these in check or in balance when trading. We also learned about indicators and price action. These are tools that any technical analyst can use to apply to their concepts in trading strategies as well as their analysis of a currency pair chart or any chart for that matter. We talked about combining tools and concepts to create strategies. As mentioned earlier in our example, we talked about combining the RSI as well as the Bollinger Bands to create a simple strategy. We then went on to test our ideas or see how they held up, also known as a back test. We then went through our example trading strategies, we talked about our crossovers, we talked about our breakouts, as well as our Bollinger Band and RSI strategy.